All right. And we are live. Good afternoon, good evening, or good morning, depending on where you're joining us from. And welcome to another episode of the iFlip AI Circle, brought to you, of course, by the iFlip YouTube channel. I am your host, Aaron Yoon. And joining me, of course, is none other than our Chief Investment Officer, Kelly Korshak. Welcome, Kelly.
How are you, Aaron? How are you, everybody?
Good. Kelly is wearing his signature red shirt today to stand out even more. You and I are wearing red and black right now. It's like the
wrong colors.
Yeah, it's as if we forgot what the company colors are.
I'll wear orange next time.
Yeah. which is totally fine. I'm just joking. All right, so we have a lot of stuff to get to tonight, folks. The market seems to be stuttering along, and it seems to be leaning more towards the downside. Is it because of the debt ceiling talks, or is it because of something else? We're going to get into all that kind of stuff, but of course, we can't do any of it until we get through everyone's favorite piece of content here, the disclosures. So please bear with me as I go through this. Disclaimer: iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip portfolios that you select are suitable for your investment profile before trading in a live brokerage account. Awesome. Okay, so with that out of the way, let me get this out of here. Kelly, I'm going to toss it back to you. Please give us an update on what has the market been doing since we last spoke, and what can we expect to see come June 1st?
Well, hello, everybody. Again, Aaron, thanks for that question. It's the way to, I think, start off all of these AI circles about where's the market and where is it potentially going, and what does that mean for everybody at Flip? So this week, very similar to 2 weeks ago, the market continues to be dominated by the debt ceiling talks currently going on in Washington, or at least I hope they are, now that it's 6:30 in Washington, D.C. The issue right now, I think, as everybody understands, is will the two sides get together and agree to avoid a default on any interest payments and, or more importantly, payments to all those government workers that work for various departments in the federal government. I think it should be clear to everybody that the way, should this happen and no deal does come to fruition by June 1st. And remember, even if they agree, they got to put Congress together and do things. So the very worst I think that would happen is there would be a delay. In other words, it wouldn't happen on June 1st, but it would happen sometime in the first week of June, where Congress meets and approves the deficit ceiling increase. But what's really going on behind the scenes is, what does this mean for the market? Should there be more calamity between now and June 1st, and or some agreement that is imminent that might come by, say, Friday or even over the weekend? My interpretation of this is that last week we had a little sell-off. If you can kind of see it, if I zoom in, this little sell-off here that occurred just in the beginning of May was when the budget talks were starting to come together. And at that time, there was no talks. There was just no talks. Joe Biden refused to meet Kevin McCarthy, despite the outreach from McCarthy. Then when Biden did start to say, okay, let's talk and negotiate, the market started to move up, as you can see it here. I remember there was a pivotal day when they realized that maybe a deal was going to be reached. That was this day right here, which was the Friday the 5th. Seems like just 2 Fridays ago. And we were talking on the AI Circle the Wednesday before that. So 2 days before. Now, of course, here we are again. And today is Wednesday, another AI Circle day. Just like I think this day was. And my point was, at that time, where was the market? Where is it going to go? Based on what most people think and what even I thought and where I can opine. At the end of the day, I felt and still do that the market is very vulnerable to some downside movement. The money that is sloshing around in the economy is preventing that from happening right now. So right now, I have to admit that I thought some of these corrections would occur before summer, even before June, and if not in June. Now, given the fact that all of these things have not matured as I expected before, I'm just going to do this. I'm going to put that on pause and say, let's wait a little bit longer. I think the events that I'm looking for are near. And that means that it's sometime, even after they pass this agreement, the markets will realize that the 2 letters AI that hold up 5 stocks, these 5 right here, Meta, Microsoft, Apple, Amazon, Google, these 5 stocks, essentially the FANG stocks, are accounting for all of the S&P gains this year. As we stand today, we stood 2 weeks ago. The Dow Jones Industrial Average is now down on the year. The Russell 2000 is down on the year. Of course, the triple Q, the thing that represents the NASDAQ, of course, is going to be much higher on the year, as evidenced by this. This is a year-to-date chart of that. And we see it's gone from about 268 to 335. And so that's an increase of about 70 points. That's about 27% just in the highly weighted to the FANG stocks triple Q. All the market's gains are coming from 5 to 7 stocks, mostly 5 stocks, the FANG stocks. They have moved higher this year. Why? They represent those 2 beautiful letters, artificial for the A and the intelligence for the I, that is driving the market higher. The idea of AI changing the world we live in is very exciting this year. Admittedly, Flip, we use those 2 letters as well. We do have artificial intelligence and AKA machine learning that allows us to be able to try to predict the market. So those 2 letters right now have come into full play, as if the world is now going to instantly turn over to a bunch of robots. And so the market, as usual, is getting ahead of that and buying these things. And so that's why these stocks are up. Those 5 stocks are accounting for all of the S&P 500's 7% gain year to date. So what does that mean in the coming weeks? Well, if the trend continues in these stocks, and let's go scroll through them very quick. Look at Meta year to date. Meta is literally up 50% more. Year to date, it's up 50%, but it's up from its lows literally 150%. Microsoft, similar. From its lows of around 216, it's 318. That's another 50% gain. Apple, a little less, but from its lows, 126, it's up to 171. So that's about $50. So that's up about 40%. Amazon, from its lows, about 83 up to 120 or 116, is up at $1630 on 80. So that's up about 34%. So as you can see, these stocks, the ones that we all know, and we, by the way, love, we do not belong in any of these stocks right now. However, they could turn into buy signals in the future, but right now they are not. And that is holding up the S&P 500 in its entirety. Meanwhile, interest rates, let's go to that. Interest rates, as we all know, have topped off now. It seems to be at about 5.2% on the short-term 1-month T-bill. They are running at about 3.7% on the 10-year note, which is up markedly, about 25 basis points, also over the last 3 weeks since we spoke last. What does that mean? Well, that means that the yield curve continues to be inverted, but by the way, it's even more inverted. Inversion of the yield curve, I've heard you've probably heard this a million times, but even from me, inversion of the yield curve also spells future recession. It has every time in the past. Now, I personally recognize that the past doesn't always predict the future. Whether we're using an algorithm or machine learning or even an opinion or any data, it doesn't necessarily reflect the future. The crazy thing that's happened in this particular case, why we have an inverted yield curve and a market that is really done very little in the broader market, and we just saw 5 stocks rally, a market that is trying to reevaluate itself under some new environment of AI. And these 5 stocks, the mega stocks of our time, the stocks that we all know, are literally holding up all of the market itself. Years ago, over 100 years ago, when the Dow Jones was formed, the stocks that would hold up the entire market were General Motors, General Electric, the company's Ford Motor Company, the companies that founded the country. They were the staples of their time. Obviously, nobody thinks of those as the staples today. But today, everybody does recognize that Microsoft, Apple, Amazon, Netflix, even Meta do represent things that most of us in our lives touch in some way every day. So those are the stocks of our times. Can they carry the market higher by themselves? Yes, they have done that before. They have done that actually for many, many years. Literally, these 5 stocks have the ability to hold the entire market up. But there's a difference this time that we have to point out. And this gets a little bit complicated, but I'm going to do my best to put it in layman's terms. As the market goes higher, as for example, an Apple with a market cap now of about $2.7 trillion, as it goes higher and people buy it, it represents an even greater share of its influence on the S&P 500. Because the S&P 500 is market cap weighted. In other words, the stocks with the most market cap get weighted the highest. So, of course, these stocks are now filtering to the top, the FANG stocks. As they filter to the top, they actually create a cycle that makes them even more important. So as people buy just those stocks and nothing else, it can actually just hold the entire market up. Might have heard that, and I might have said this in the last meeting, the last AI circle, that 2 weeks ago, that these particular 5 stocks, had they not gone up, the Dow right now, and they just stayed where they were at the beginning of the year, the Dow would be much further down in the year. It'd be down about 15%. And the S&P, without these 5 stocks, had they gone nowhere, would be down about 9%. In other words, these 5 stocks account for the entire rally of the S&P 500 this year. And because they're not, for example, a big component of the Russell or the Dow Jones, that's why those 2 indices are lower on the year. So generally, when you see a yield curve that's inverted, and you see just 5 stocks, no matter how influential they are, holding up the market, recognizing that other major indices are down, yet these are up, do we have a strong market? I affirm and say, no, we do not. We have a very weak market, a market that is refusing to go down only because a few stocks are going up. It actually wants to go down. It doesn't want to go up. It wants to go down. It just is being influenced higher by those 5 stocks. So what does that mean for all of us? It means a delay. It means feel that these 5 stocks, their potential because of the AI buzzword this year and people wanting to have a piece of AI, that's their FOMO, their fear of missing out, are holding up the market, and it's just a matter of time before it all crumbles at some point. Sometime now, I have to push it off at least 2 more months and say that this probably now will take till August to mature its way lower. In the meantime, everybody, I think we hang in there. AI data, for example, on our end, is becoming even more affirmed to keep us out of the market. It seems that the higher we go, it doesn't seem to stop credit card expansion. It doesn't seem to stop credit card defaults. Those information that we get week to week. The most recent week was last Wednesday. We'll get more data today. Is showing an even further expansion of credit card usage and even further expansion of credit card defaults. That plus interest rates creeping up again, and a higher Fed funds rate futures are now predicting a 30% chance that there will be another hike when most people think the hikes are done. Tells me that the market is very vulnerable to a downside move. Probably within the next AI circle, we'll be talking a little bit differently regarding the market.
That's actually a great segue, because I just wanted to let people know as a housekeeping item. Next week is the 5th Wednesday of the month, and we get that every few months, and so we won't have a show then, and then of course we never have a show on the first Wednesday of the month either. So we're gonna have the next 2 weeks off. So there is a longer than normal break period for between now and the next AI circle for the market to do quite a lot based on what you just said, Kelly. We do have a little bit of time, so I do want to ask 1, maybe 2 questions. First, it's very interesting what you said about how the S&P is weighted. So the more that Apple goes up, if I'm doing my math correctly, the more weighted it becomes.
Yes.
And so it's almost as if it's like compounding its influence as the market becomes more and more inflated, and as you often say, bifurcated, right? The split between the strong stocks and the weak stocks is like really very severe and kind of polarizing. So can you explain why they designed it that way? Because it would seem like then it's more misleading.
I would.
That's my impression of it anyway. If you could elaborate.
Years ago, if you took the 10 deciles of the S&P 500, in other words, you broke it up into 50 stock increments, right? If you have 50 stock increments, you would have 10 50 stock increments. The stocks with the highest market cap would be in the first increment. The stocks with the 50 stocks with the lowest market cap would be in the bottom decile. So years ago, when these things, if you were to do this distribution and just divide them up by 50 stocks 10 times, you would find that the market caps were generally very normal between each 50. There's a difference today. The first 50 stocks, if I take that first 50 stocks highest decile, what'll end up happening is there's a huge skew. What's happened is the world has moved into mega companies. It's Orwellian, 1984. Which this means is that we are now being dominated by corporate America, very similar to the way government America works. The government is in our daily lives, but never before in history was these 5 companies so influential in our daily lives. So in a way, these companies are like the government. And what the government does, we must follow, sadly, in many cases. But these companies have come to such influence that they now, in total, the top 10 companies in the S&P 500 represent 26% of the entire S&P 500. So the skew has changed because of these huge conglomerates that never existed before like this, and the distribution is skewed. No one, maybe, Aaron, 10, 15, call it 20 years ago, would have understood that the dominance of an Apple could be this great, where literally, if I were to go to your house, there's probably an Apple phone there. And if you came to mine, there is too. And I would say to everybody out there, I'm sure if you look down at your phone, you're either holding an Apple or a Galaxy of some sort. And that is the influence of this world and these literally mega companies.
So
That is a change that has occurred that really wasn't foreseen in such a way. But your statement is exactly accurate. They actually become, the bigger they become and the more people pay up and drive their prices higher, the more influence they have, which tells you that if something ever goes wrong with it, these markets will move down in a hideous way very shortly. And the fear would not be of missing out. The fear would be of being in.
Right.
So what would you call that? Phobia?
Well, we coined the term for iFlip customers who had felt the joy of not being in the crashes and during COVID and last year. We coined the phrase JOMO, the joy of missing out on the crashes. That's the iFlip. That's the new iFlip slogan, everybody. It's JOMO. But Kelly, you bring up something. This is absolutely fascinating, and I'm just want to wrap up this point with if it's already kind of like, to me it kind of sounds like you're saying it's a little bit out of control how influential a handful of companies are in terms of like to influence an index that we've come to, like, my entire life I've looked at the index, the S&P 500 index, as something that's balanced and fair and yeah, just unbiased. But it sounds like it actually is kind of heavily biased, considering mathematically the way that it's calculated. So
Yes.
So then why won't they change it to something that is a little bit more fair and that isn't so misleading? Why is this on? Is it intentional? Like, or do they have any? Is there any kind of plan to modify this later? Like, it just seems like the strongest company keeps getting stronger. So is that a concern?
No, I don't know if it's really a concern. It's just a point to be aware of. So, for example, the Dow Jones doesn't work that way. The Dow Jones Industrial Average is not market cap weighted. It is balanced evenly. It's a different form of, there's many ways you can calculate an index. One way, of course, is market cap. The value of the S&P 500 is approximately $33 to $34 trillion. In other words, if we added up the market cap of each company, it'll be $33 to $34 trillion. Well, we know Apple is $2.7 trillion, which means right off the bat, you know that that's about 8.5% of the market cap of the S&P 500. Right there, you know that. So it also happens to be greater than the market cap of the entire Russell 2000. So it's not like that's a bad thing. There is no going to ever be, I doubt, a plan to reorganize the index into something that represents more of corporate America. Years ago, the corporate America was kind of being tried. The Dow Jones, when they first formed the index, was designed to say, what does this mean for employment? So, for example, over 100 years ago, General Motors, Ford Motor Company, General Electric represented the greatest amount of companies that employed the greatest number of people in America. And as those companies did, so did America. So if those companies were doing bad, they would lay off people, there'd be higher unemployment, and vice versa. Today, the S&P 500 index was saying, no, we'll do strictly market cap. In other words, whatever people pay for the stock will be its value. which is a fair measurement. However, I don't think the founders of this really believe that there'd be any stock that could represent so much of the market cap. And so, for example, Apple, of course, does that today. These are issues that the founders of the index never probably foresaw. And had they foresaw them, who would say that they would do things different? The bottom line, Aaron, and for everybody out there, is that there are a number of problems. Generally, a bull will say these are the wall of worry that the markets must climb before they go higher. They look at all the problems: the inverted yield curve, the unemployment rate, the inflation rate, the value of a company. Is it overvalued or undervalued? They look at all the things, these budget deficit talks, the lack of leadership in the country, the various things represent the wall of worry that the market generally tries to price by going higher. It climbs the wall of worry and it falls in the sea of fear. So the market really, however, in this case, mathematically, it is not really going up in a wall of worry. It is not climbing a wall of worry. We are buying corporate America large corporate America, the mega caps are being bought by the largest funds out there. These are not investors. These are the BlackRocks, the Blackstones, the various large funds and money managers that represent the wealth of the country. They're just pouring their money into these stocks. This at some point will stop. And when it does, the market will go lower, and significantly so. Something always occurs to upset that. So in this case, I don't feel it's a wall of worry. I feel it is where else do I put the money?
Right.
Put it into this mega cap, or I put it into some bond or T-bill that'll pay me something very, very safe. And by the way, it's pretty safe to get on a 30-day note to get 5% on a T-bill. And you just keep rolling it. If those people out there know how to do it, you just roll T-bills, get your 5%. That's going to be sticky and you have no risk. And every 30 days, you just do it again and again until the interest rates either go higher and you make more money, or they go lower and you make less. So this, to me, is a very different scenario. I'm sure most of the people out there listening to me have heard this before. The difference, I think, here is that, supported by all the other data that, in our case, as Flip users, we look at the machine learning component, and the machine learning components are not liking the market. They see things that we hear of, but they put this into a mathematical way of interpreting them. And the interpretation, of course, is not done by me. They're just largely in the pejorative. They don't like the market.
Right. We actually did get an interesting question here from someone in the audience who actually brought up something that you and I were talking about offline before we got on the live stream here, about banks failing, and how is it relevant to just everyday normal Americans like us? Like if you're just a normal person, how does that actually affect you? Now, we did get a question. We usually don't take questions on the AI circle, but we will in this time, because it's so related to something we wanted to talk about anyway. Coincidentally, I have some money in a checking savings account in a smaller bank, Ally and Charles Schwab. Not a large amount, less than $100,000. Should I worry about losing this money if these banks fail? I think this is a legitimate question from just a normal person perspective, because if we see more banks failing than we pretty much ever have in recent history, should I be worried about my own bank? And what do you say to that, Kelly?
No, you should not worry about your bank. I think we spoke a little bit about this on the AI circle last time. And what I remember saying, and it's still true, is that we have saw when the first three banks, First Republic, Signature, and of course Silicon Valley, they all failed. We saw the Fed bail them out. The FDIC, even though it didn't have the money, the Fed came to the rescue again and bailed them out. And they bailed out even people with much greater amounts of money than a $250,000 reserve. So right now, if you're under 250, of course you're protected by the FDIC. The government will never allow that to fail. But then again, there was many clients in all of those banks that had much more money than 250,000. They had tens of millions in these banks, and the Fed covered them as well. So no, you have nothing to worry about at Charles Schwab or even your local small bank. They will be bailed out. You may not have access to the money for a few days, but if you even look at the example of any of those three banks that I just mentioned, you'll see that those people got their money out within a week if they wanted it. So nothing to fear there. That I feel was, it's a scary thing when you see a bank fail. Banks shouldn't fail in a good economy, but we're in a good economy that has a lot of cash sloshing around of unspent COVID money, states trying to get rid of it because the federal government now may want to try to claw it back. So of course they're going to try to spend it or allocate it as much as possible. Prior to that, California already has. Of course they have. So when you see this kind of behavior, the bank's failing, yes, it's not going to hurt you, but it's still not a good sign overall that if we have such a good economy, why does a bank fail?
Yeah, exactly.
Why?
Yeah, the way that I look at that is that even banks who are run by humans for now, maybe someday robots and AI will take over the banking industry. I don't know, but so long as banks are still run by humans, humans even at at that level, at that institutional level, are not immune to poor decision making and poor risk management.
Precisely.
And getting complacent, getting lazy. These are all things that happen and can, at that level, even human emotions at that level can affect a huge domino effect for the rest of us. So, okay. Thank you for the question, Zung. It's almost like you read our minds and you were listening in on a conversation that Kelly and I were having beforehand. Trivia time, everybody. It is trivia time. Just so you know, if this is your first show for joining us for the trivia section, first of all, thank you for everyone who has stuck around this long to the end of the show for the trivia. The prize for tonight's trivia is the encore presentation, the recording of the event that we did 2 to 3 weeks ago, the Bulletproof Investing Live Virtual Summit that happened on May 4th and 5th. Is a $300 value if you wanted to purchase it today, but we will be giving it to one lucky person if you get this question correct. So the trivia question for tonight is, if I can find it, here it is. Okay, the trivia question for tonight is, who was the Treasury Secretary during the 2008 financial crisis? Cue the Jeopardy music, jump in the chat and type in your answers. If you know that off the top of your head, great. If not, your Googling skills better be very quick. So type that into the chat. First person to get the answer to this wins our prize for this evening. But as we're waiting for the answers to come in, Kelly, I'm going to bring you back up on the screen here. Let me get you back here. Kelly, why is it important for us to know what the Treasury Secretary is and what the Treasury Secretary does? Why is this important to us?
Well, it's the Treasury Secretary that brings the information to government about what the issues are or problems that the country could face in terms of the amount of money in it. So, for example, the Treasury Secretary, currently Janet Yellen, is the one that has forced the conversation that McCarthy and Biden are now having regarding the budget, the spending ceiling. So the reason these two people are talking right now in government to create a new the ceiling for the budget deficit is because the Treasury Secretary says, hey, we will run out of money. In other words, we won't have money to pay our bills. We need to have it. We need to get more. what are you guys going to do, Congress? And so Congress and the three branches get together based on what the Treasury Secretary says and hammer out the deals to be able to create the new budgets. That's why the Treasury Secretary job is very, very important. By the way, I saw another question really from someone. I do want to do a quick Bitcoin update. Right on the screen right now, if you people can see it, is Bitcoin. It is going nowhere. A while back, we all predicted that I thought we can move to 30,000. Obviously, that was achieved. But since that's been achieved, nothing has happened. We're looking here to buy Bitcoin back at around the $25,000 level. We feel that the odds are 50-50 even, that it goes to 25, actually more 67% chance that it moves back to 25,000 and only a 30% chance that it goes to 30,000, which means at the end of the day, if you just add up the probabilities, Bitcoin looks flat to probably lower in the near future.
Awesome. Thank you, Kelly. Let me get us back on the screen here. Appreciate that. It's one of those things that we often overlook how important these specific roles in government is. And the Treasury Secretary is a crucial role right now. And so, yes, we hope, of course, everything works out. And of course, we will stay tuned to the iFlip YouTube channel. Make sure you hit that like button and subscribe if you want to get our take on the debt ceiling. Hopefully not a crisis, but the debt ceiling news as things progress. We will bring you the latest on that as interpreted by, the iFlip AI and Kelly's opinions. Stay tuned to the iFlip YouTube channel. We have Kelly, you have something before I announce the winner?
Who has the answer? I want to know if anybody
knows. We have the winner. Right. So we have the winner. Time to announce the winner, everybody. But before I do that, how does the winner collect the prize? It's not enough that you just got the answer. Okay. You also have to show us that you are invested in a smartfolio. So just email us a screenshot of your account invested in a smartfolio or your account number, whichever, to mailbag@iflipinvest.com. Show that you're invested in a smartfolio, and we will deliver your winnings right away. So the winner of tonight's trivia question is, what is the answer, Kelly? Let me hear it from you first.
It is Hank Paulson from Goldman Sachs.
Hank Paulson from Goldman Sachs is the answer to our trivia question. And on my list here, the first person who gave us that answer is Zhang Doan, who I believe we met in Dallas last year, right? He was there with us. I think he won something last year too, right? I'm pretty sure he won something last year, and he had dinner with you or something like that, right? Wow.
Something I remember. I know
lucky winner. Lucky winner. So there is some skill to this. It's not just luck. So stay tuned. Pay attention to our trivia questions, and you can win hundreds of dollars worth of prizes. Congratulations to you, Zhang. Hopefully I'm saying your name correctly. We had other people submit the correct answer just a little bit too late. Sorry, Annette Rayner and Daniel Borden. And even Pellet Stove Pro. I think this is just literally a copy paste from Google. It looks like. Love it. Love the hustle. Love the effort.
Just remember, it's sort of like Jeopardy. You got to hit the button as fast as possible.
Timing matters.
Timing matters.
If you want to win. If you want to win, speed matters. But I do have a consolation prize for Annette, Daniel, and Pellet. If you're interested in getting the recording of the Bulletproof Investing virtual summit, it is a $297 value. If you're interested in that, I will hook you up with a discount code to honor the early bird special of it. If you had pre-ordered it, it was $47. If you're still interested in that, I will honor it for each one of our three runner-up winners, Annette, Daniel, and Pellet Stove. Pellet Stove, you're going to have to show me that was your account. I don't think that's your real name. That does it for tonight's episode of the AI Circle. If you enjoyed our content, then please hit that like button to show your love for iFlip. Make sure you hit that subscribe button so you don't miss our yes, the thumbs up button. Make sure you hit that subscribe button so you don't miss the next episode, and make sure you keep that notification bell on because that's the best way to tune in live. So that does it for this episode. We will see you in a couple of weeks. The next 2 weeks we have off, and we'll see you second week of June, which is, let me give you the date here, June 14th. We'll see you then. Good night.
Bastille Day. See you, everybody.